So welcome again. Today we are going to see what losses in your portfolio valuation really mean and when to add more. Most people panic when they see the shares going down. And maybe if you look on the Apple portal, it is in negative and showing red color. That does not mean you're losing. I've done a full video on how to realize gains and losses in the market in terms of capital gains, where you must sell. You must sell to realize those losses. In most cases, the losses may signal you add more. Remember, we have done a full video on DCM. So most people will panic when they see their numbers in red or they see negative. But a loss is not always a problem. Sometimes it is a signal to you. Why? What that means is the current price is lower than your average cost. So you have the average cost, that is price you bought share at, and the cost that you incurred, all the shares in the average up to the current. Then the current price doesn't include cost. So if your portfolio is in red or a share is in negative, it means the current price is below your average price. So that is what I'm calling a signal, and you'll see it is a signal to do what. So today we learn what portfolio losses mean, when a loss is an opportunity. Remember, a loss can be a very huge opportunity for those who have been in the market and who have seen the previous videos on how to do this here. Also, how dividend stocks help you recover faster. If you have invested in any dividend stock, we will see them in the next video. Dividend stocks and stocks that you need to hold for long term and the ones that you need for short term, and how to use GTD orders to buy at better prices. And if you have any question, you can always reach out to me on my WhatsApp number. That's my WhatsApp number. So what does your portfolio show? Your portfolio is not same as stock holding for those who are on the online portal. For those who are on mobile app, you only see portfolio valuation. Your portfolio valuation will show you the share name, the number of shares you have currently, average buying price, that is all the prices you have bought at. You get the total cost, you divide by the number of shares. So that is tentative, the average buying price per share. So if you have to multiply that with the number of shares, you get the total cost you have incurred. Then it also shows you current market price. So the difference between the two is that average buying price includes the cost. It has levies, it has a brokerage, and any other charge the broker have charged you. If you had to print contract, a contract is a report that shows you for each stock how you have utilized your money, what charges have been levied. You may realize you have bought a share, let's say at 10. That's the price you put. But when you got portfolio valuation, it will show 10.5 or 11. That difference of 0.5 or 1 is usually the cost you have incurred. It is included in the average price. So that when you multiply that times the number of shares, you get the total cost you have incurred to buy those shares. Then the current price doesn't include the cost because you have not sold. Current prices, if you are to sell today, what price would you sell at? But remember, you have not sold, so it doesn't include cost. Then portfolio valuation will also show you current market value. That is the number of shares times the current price. It tells you if you are to sell, this is the amount you get, but you have to factor cost of sale. That is not included. What does that mean? Now, the difference between the market value and the total cost is either the profit or loss. If current market price is higher than average price, then you'll be in a profit. If current price is lower than average price, it means you are in a loss position. But remember, in shares, it's not the actual loss. Shares is not like Forex or CFDs where you are using on lead time. You only lose when you sell. When market rebounds back and current price goes above your average price, then it means your portfolio is in profit again. So when price drops, the current price goes below your average price, that's when you see losses. And I've seen most of investors, when you buy shares, you want it to be increased the same day. It can't. Remember, the price you bought at includes the cost. Current price doesn't include. So when you buy, the average price includes cost. That may give you your portfolio as if it's in the loss. When you get into shares, don't have that anticipation you can get profit the same day. I'll do other videos where you can make money the same day, but it's not advisable. In shares, it's all about patience. So when you see shares in loss, it means current price is lower than average price. So this is a screenshot on online portal. I use online portal for my demo account. If you ignore the screen where there is net worth, portfolio value, and ledger balance, we come to where there is equities. You notice I have several stocks. APSA, one share. Average price, I said, is the average price of buying all those shares. Then there is market price, is the current value. So current price, then market is value is quantity times market price, which gives you that. Then if you have to subtract cost from market value, you get the profit. Like for APSA, it is in a small profit, but again, it is one share. Now, if you look at a stock like which one? Kengen, you notice it is in negative 352. That means this share is in a loss. If I was to sell today, I would sell at a loss. And what did I say? Market price is 920, where average price of buying the 380 shares is 10.13. A part of that is the cost. So what does that mean? It tells me Kengen is in a loss position. If you look at Kenya Re, it is in a profit position, and you have the percentages of the losses. So this does not mean my Kengen is losing. Yes, in paper it is losing, but in actual sense it's not losing because I have not sold. You only lose when you sell, because when you sell, you remove the shares in the equities, then the ledger balance moves up. So that means you have already sold. So what does a loss signal? It's one question you need to always ask yourself. The shares that you have here in your portfolio valuation, first of all, are they dividend stocks or not? If they are not dividend stocks, I think here, I usually buy dividend stocks. It's only cable and it was suspended. If I had cable, let's assume it is trading. This means I'm in a true loss position, because if I was to sell, I can only wait for prices to go up. And when prices go up, I don't need to hold that share, I need to sell off. The rest gives dividend. Even if they are in a loss position, I can hold, keep on accumulating dividends. Then when price goes up, I can decide to sell. Like now, something like Co-op, I can decide to sell. But again, this is a small profit. Don't run after profit. So the first question you ask yourself, is this a strong dividend paying stock? If you're not holding strong dividend stocks, as we see in the next video, you then need to ask yourself, is it wise to wait for the dividend, or is it wise to take capital gains? But remember, when you sell and you want to buy back, you have to wait for market to go down. And market have cycles. It's not a must it goes down. Even when there is a cycle where we expect the prices to go down, they don't go with a huge margin. The only time we had downtime, I think it has happened twice. One was when there was instability in the political environment around 2000, way back. And then when there was introduction of 2023 finance bill, and I think 2024, that's when we saw market drop. After that, the market keeps on fluctuating. It will go down, it will go up. So the rally that you have seen is not all about share prices appreciating. No, we are just recovering from what happened in 2023, 2024. So if it is a dividend stock, whether strong or as long as the stock is giving dividend, a loss often signals two things: temporary price weakness. It means the price have just dropped. Maybe demand, supply suppressing demand, where maybe either foreigners are exiting, locals are exiting, maybe for a holiday or to do something else, or there is market panic or low demand. When there is low demand, it means people are willing to sell. But remember, when there is too much supply of shares, it will keep on executing. Remember, there are people who are putting market orders, so they'll keep on pushing prices down. When there is market panic, a news is just announced, then everybody panic, you want to remove your money from shares. You all want to sell. You surpass demand, so prices go down. It's not usually a business failure. When a company is not performing well and they announce profit warning, that's the only time you need to be worried, because you need to wait and see, is this warning going to affect company in the long term? If it is not, then it doesn't signal there is a failure in business. So losses in your portfolio are affected by temporary price weakness, and when there is a low demand or market panic, it doesn't mean that company is not performing. This is usually the right time now to add more shares. Remember, you have done this year. Let's go back to our screenshot here. If you look at Kengen, at the point of recording this video, current price was 920. Average price was. If it goes, let's say, to around 7 or 6, I can buy more and push this average price of 10.13 downward, maybe to around 8. I would only need to buy more shares at around 6 or 7, push this average cost to around 7, 8. Then when Kengen improves, let's say it goes back to above 10, 11, 12, 13, I'll be in a very huge profit position. So that's how, as an investor, you come and think. You buy more shares when prices are lower. When the market price is lower than your average price, and you realize you have a huge loss, you can reduce that loss by buying more shares at lower prices. But that only works with dividend stocks. If you are trying the other stocks that don't give dividend, then be sure to sell when market improves. Otherwise, you just be playing paper profit, which I've done a full video on. So why then do you need to add more shares when your portfolio is in losses? One, you buy at a lower price than your average cost. So what happens? Your average cost now comes down. I've explained that with the example of Kengen. Remember, dividends are still coming in. Even if your portfolio is in loss, this company, if it is declaring, you are still getting extra money without selling shares, which is free profit, which you can be accumulating. Then when price recovers, your portfolio now turns green. But remember, if you don't sell, this is paper profit. It is you as the investor to make a decision when price improves. Do I need to sell? If share price keeps on fluctuating, you can sell, then buy low. If your average cost is not way low. If it is way low, then don't try to sell, because then when you're buying back, you'll be moving that average cost up. So don't play with your portfolio. That's why I said I'll do a full video now. You can play with prices. But if your average cost is way low than the current price, don't be tempted to sell. You keep on accumulating dividends until when you need money. However, if that average cost is near your near the current price, but you have made huge gains, you can always take profit, then buy back again at a lower price than your previous average cost. It's all about market timing and also the choice of broker. I work with the IB Access, and as said in the previous video, we always connect our trading system to NSE by 8:30, sometimes early 6, all the way to around 8:40 latest. So that by the time market is opening 9, you are ready to place your orders, if you are placing orders there. Our system, you can always place orders even when we have not connected. When market is closed, then they will be pushed at the same time around 9. Between 9 and 9, that is pre-open, no execution, it's orders queuing. So if you placed your order early, let's say exactly 9, or you placed before that and your broker submitted that order early, you are the first one in the queue. If your queue has the lower price, remember market when it opens, there are market orders, that's when they come in. They come and start clearing. They might clear even your queue, maybe the first orders. If you are the first one in the queue, you get the opportunity. If you are not, then you lose. That's why choice of broker also matters. We'll come to all those videos. I'm also doing a beginner series which explains everything. Let's take a good example. You own some shares, 1,000 shares of one company. You bought at 50. So your total cost is 50,000 plus commercials. Price drops to 40. It means now your current value is 40,000. In your mind, you think I've lost 10,000. You have not lost because you have not sold. If price goes to 60, remember now above shares have not changed. It is still 1,000 times 60. You go to 60,000. You make 10,000. If you don't sell again, you don't realize that profit. So when price goes down to 40, instead of panicking, buy another 1,000, maybe at 40. So in this case, you have 2,000 shares. Total cost, here I've not factored commissions. So it will be 40,000 plus 50,000, which comes to 90. If you average, then it pushes average price down to 45. Now, compare that with your original purchase. You bought at 50, now it is at 45. Even if this price recovers to 46, 48, then portfolio turns into green. So this is what is called DC. Try to buy as much more shares as price goes down. When price goes up, buy small number of shares. When price is up, just buy in small number of shares. When price is way lower than your average cost, that time add more. Push your average cost down. So when price recovers above now the new average price, you are in profit. And remember, this is a company that is giving you dividend. They are still coming in, whether it is in loss or profit, dividend are coming in. So the price that you buy at matters more than anything else. And again, I'll be doing video now on the choice of prices, especially for each stock, so that you know every stock has a way you can buy and buy at a lower price. So what happens when price improves? Market prices moves above your new average cost. Your portfolio turns into profit. And there you have two things: capital gains if you sell, and dividends. So which equates to faster recovery. But remember, capital gains you have to sell. And when you sell, you forfeit the next dividends. So always take caution of that. So if you're selling, unless it is on book closure, and you realize taking profit is higher than dividend, you can sell that time. Then the following day, it's ex-dividend date. Again, I said choice of broker. Very early in the morning, around 9, place your order at the lowest possible price. That time, it is called open day. Prices start from 0 all the way to the highest price. Put the lowest price you think can execute. And here you need to be factual. Don't put a share that is trading at 40, you're putting a price of 1. Definitely, you can see people placing orders between 9 and 9:30. Always check. And we said, always check where demand is concentrated. Where there is strong demand, that is the highest quantity in terms of queues. Always place your order just slightly above it. There are chances of getting at that lower price. But when you're playing with these again, realize the cost, the average cost, the current average cost before you sell. If it is lower, there is no need of selling. Because when you sell, again, you'll be forced to buy at a higher price unless you're selling to buy another stock. So even if your portfolio is on loss, dividends don't stop just because price dipped. Always notice that. So then how do you reduce losses? The question you ask yourself is, how do I buy at the best prices? Let's look at this screen for KPLC. You notice there are different prices. And the lowest it has traded was 130. is at the point of taking this screenshot. You can see on the graph, it is there on the online portal, even on the app. If you click on any share, you go to market depth, you scroll down, there is that graph. You need to zoom it a bit to see. It's a candlestick. Huh? If you notice KPLC, at the same day, there is somebody who bought at 170 and there is somebody who bought at 130. There is a difference of 40 cents. This is very huge margin if you're buying a lot of shares. Why? Because there's somebody who is at the same day buying at high price and there's somebody at the same day buying at a lower price. How does it work? One, using good till date orders, GTD. So when you're placing order, where there is validity, you select, you remove day, you put GTD, then you put 1 week, then put the lowest. Like in this case, if you have to put the market closed at 1135, you can decide, I'll put at a price of 11. There's a possibility because the following day it will open at 1135. Then there will be the 10% rule execution. The first execution, they set the price. So that time you have a chance. So if it closed at 1135 and there was a lowest of around 1130, it means the following day, there is chances this market can give you even at 11. So you put a GTD, a limit order, number of shares 1,000, price, because you have selected limit, you have to put a price, put 11. Then select validated date, give it 1 week, leave it there. Your work is just to monitor. So always target lower prices, not current market price. Like here, if you are to buy today, you buy at 1170, but you're incurring extra cost. Notice there are people who have put at 11 because they know there is possibility, especially when market opens. Notice when market opened 1150, then during the chaos window very early in the morning, it went all the way to 1130. Then because of when market stabilized, there are people who come and start putting market orders because you think you still get 1150. Remember, market orders, you are carrying everything. If your quantity is high and there's somebody else also placing market order, remember there are orders coming from other market. You continue clearing whatever is above. That's why some of these people buy at high prices. Don't place your order at market or market to limit. Always use limit, put a lower price, leave it with GTD. The next thing, always look at the order book, market depth, the screen that is split into two, blue and red. Never be tempted to swipe on the app to get the order entry. Click on the share to see the market depth. The screen is the same, split into two, bid side, offer side. On the app, offer is ask. So always look at this to determine how strong is this market, how strong is demand, where is the strongest demand. Like here it is at 64,000 quantity at 11. 3 orders. Split is the number of orders. So I can decide I can give NQ at this price or even lower than this. So remember, there is that range you are given. Always utilize that. When I'm doing a video on each share, I'll start with BAT, then EABL. I'll show you how you can target lower prices for each stock. Each stock works differently in the market. Don't be told here you come and buy at lower prices. Each stock has its own strategy. So the first thing is buying pressure strategy. Identify the price level where there is very high bid quantities. Like in this case, we have 2,000, 2,000, 25,000, 64,000. If you notice, 25,000 is just one order. 64 is 3 orders. It means 3 people queuing. In this case, the strongest demand, we can say the highest bid quantity is at 64. So these are strong demand zones. That means you must get 64,000 shares to be sold that day for your order to be taken. Remember, there are also other orders above you, 27,000. So you add to that. So if you want to get execution, place your GTD order slightly above that level. Or, because in most cases, these are orders placed the same day to expire the same day, you can give it a GTD. Remember, if the broker connects and submits your order before 9, like IB Access will submit before 9, so that by 9 your orders are in NSE. that time you get execution. If the broker cannot give you that, if you're trying to place the order and it's not going at that point, you are losing. Unless they have an issue with NSE, CDSE, or their system. If it happens continuously, then that broker is just joking. And I've seen, unfortunately, I don't like watching stock market videos for other people because they didn't break down me. I've seen some of the brokers they are recommending, and I have clients there who have given me their platform because they can't trade, and you end up being frustrated. You're able to submit order past 2 p.m. So how am I helping that client? And that broker is being recommended. Remember, influencers, they work for money. They are being paid to promote these brokers. They don't work for your interest. Always keep that in mind. Always check, when does my broker connect to NSE? If it is not before 9, you are losing opportunities. And using GTD, because GTD won't work if the broker is not connecting you. You'll only be praising GTD just for the sake of it. In some cases, you can even praise a price below. Like this is 11. This is a small quantity. You can decide even, because KPLC, you can find even 100,000, 200,000, 500,000, 1 million orders quantity. So you can even praise below this at 10 if the system allows you. Leave it there. That is if you are patient. If you are quick to execute, be sure you execute at high prices. An important NSE reality. Some of these big orders you see, like you come and see here, it is 1 million. It is only valid for a day. Somebody placed it on an NSE system just for that day. If it doesn't execute, they forget. The next day it won't be there. Maybe it will come later. Maybe they have even panicked. They want to wait for the market. If your GTD order is sent to NSE at 9:30, it is the first one. Remember, I said 9 to 9:30, that's when orders are queuing. If the order was submitted at 9, it is the first one in the queue. Then at 9:30, when market opens, it will be the first one. You get good prices. If your price is right and there is a huge demand for that share, you get high chances of execution. Remember, I said they are market orders. Market orders are afforded by brokers from 9:30. That's the time when I see around market orders. And that's the same time if you have to come to buy at that time, you put a price that you can see. Most of us panic because you want shares immediately, you put market. You come and clear everything, even the lower prices. So that time, if you had to put a GTD at a lower price, broker connected you, you get the execution at a lower price. And that's how institutional trades accumulate quietly. You never see an institution or foreigner coming in to push with your prices. They usually put lower prices. Those orders, as I told you, you will never see them in the market and never be right that people are sitting. You come and check on market depth. In market depth, they will not show you. Go to the online portal, go to watch list. It has the details. If you scroll to the right, that screen, it has foreigners. And if it's not foreigners and there is a huge supply and demand, no, it is. And of course, you are exiting or buying if it's buy side. Like this 64 may look small, even 25,000. But in the previous videos, if you have seen, there's something I call disclosed quantity. In this video, in this channel, because it is not affiliated with broker, even if I keep on talking about the IB access, it is not affiliated with the IB access. It's my personal channel to expose what happens in the market. There's something called disclosed quantity. When you're submitting order, yes, your order you have put 1 million, but disclosed quantity is 10,000. This is what will be shown on market depth as 10,000. But behind that order, there is 1 million that is clearing. That's why you find like this 2,000 may keep on executing. You'll only be seeing this 2,000 is not moving. It moves, then another 2,000 pops up immediately. Those are called disclosed quantity orders. They are allowed, but on the app, we have not allowed that. On the broker side, client-facing application, it's not allowed. But for the traders, because they have that expertise and experience, they can do that. So disclosed quantity will only show on the market depth, but behind that, there is a very huge order. And I hope that is clear. So when you see losses in your portfolio, one thing you need to come, let's say it's KPLC have losses and current price is 1170. I can target to buy more at 10. I just put a GTD. Like let's take an example of KPLC. My average cost is 13. Current price is 1170 or 1135. Definitely my portfolio will show at a loss. Huh? But unless I sell, I won't realize that loss. What do I need? If I come and place a GTD at 10 and I happen to get those shares, then you may find that average cost may move from 13 or 12 all the way down to around 11 or even below that. Market recovers again, even the same day, portfolio will turn automatically to green. So never panic when you see losses in your account. You just only need to buy more, even at lower prices. And remember to like and share and also subscribe for more. And I'm also on other social media accounts. Let's meet in the next one. Thank you.